Hey, everybody, and welcome to week 7 of the economics of cryptocurrency. Let's go ahead and jump right into it as we have some stuff to get through this week. Um, quick announcement. I just want to make sure you guys know you can reach out to me if you're struggling with either the collab assignments or the quizzes for some reason. A few people have been appearing to miss the quizzes. If you reach out to me after you miss a quiz, I might be willing to let you try to take it again with a penalty for being late, but it should be pretty clear that the quizzes are due on Friday evenings and the collab assignments are due on Sundays. I have worked with some students who have had life events get in the way of getting those in on time. The important thing is that you just communicate with me about that. And I'm happy to communicate with you about those issues. So please do not hesitate to reach out, um, because we definitely have some grades suffering as a result of that. Today, we're going to be talking about some exchange rate stuff, some smart contract stuff, and some on-chain data. I'll be deviating a little bit, really going into more deeply into some of the issues that are mentioned and discussed in the reading this week. The reading is a little bit longer, but it's not a very intense reading. It's really a lot of it is like information about the current Bitcoin infrastructure, or I shouldn't say current, because some of those things have changed since the writing of the book, and we're going to talk about some of those today. So, for the first part of this lecture, we're going to be talking about exchange rates, something called dimensional analysis, which really is a skill that is very multidisciplinary and shows up in all different types of places, but it'll show up in exchange rates, and we'll talk about that today. And then we're going to talk about this special thing that really only exists on or doesn't exist on the Bitcoin blockchain, but exists on the Ethereum blockchain called smart contracts. And we're going to go into a couple specific examples of those because I think that you can really help think about and learn about finance when we actually think about those types of contracts. So, and we can learn about the finance of cryptocurrencies, but also the financial economics just in general. And I'll point to the connections to broader markets when we get into those examples. So we have two parts. The main part is going to be on exchange rates, dimensional analysis, and smart contracts because I'm going to do a couple pretty deep examples. But then we're going to do something more similar. We're going to look at some data that the book directly discusses in this reading, but we're going to look at some more up-to-date versions of that data. And then you'll play around with both of these for your assignment this week. So briefly, you may have not, if you've taken like international finance or some other finance classes, maybe exchange rates have shown up. And generally, traditionally, when we think of exchange rates, we're thinking between two national currencies, like the US dollar and the euro exchange rate, for example, or the US dollar and the yen. Well, if we're thinking about Bitcoin as a currency, it might be better to refer to the price of Bitcoin as an exchange rate. And a lot of sort of papers and things like that, and some math we'll look at later related to the economics of mining generally does refer to those things as exchange rates rather than prices, although in the popular media and when we look, it will generally be referred to as the Bitcoin price. And that really comes down to, are we thinking of this as a currency or are we thinking of it as like a speculative asset? Either is go because even in the euro, we could say the price of the euro is about maybe $1.20 today. I don't know exactly what it is, but we could say that's an exchange rate, but we could also say, well, that's what the price of 1 euro in terms of US dollars is. So it's good to be flexible in that interpretation across the board because really it's a matter of semantics. They are the same thing. An exchange rate is a price. So let the exchange rate between US dollars and Bitcoin mean US dollars per Bitcoin. So right now, maybe that's about $68,000 or $69,000, where I'll actually see in a second in this notebook. And then we can say let the exchange rate between BTC, Bitcoin, and US dollars mean Bitcoin per dollar. So that will be a much smaller number. That will be 1 divided by 68,000 approximately. And we could also write these in fraction form, which is going to be useful for this thing that I'm calling dimensional analysis, as I show you in just a second. So we can think of just a really easy numerical example. So let's suppose that the Bitcoin, or sorry, the USD Bitcoin exchange rate is $1,000. So again, this would say what this is saying in this example, not true today, but easy number, is that one Bitcoin is $100,000. So that's the price. Another way to say that is the exchange rate is 100,000. So 100,000 US dollars per Bitcoin. Another way to say the exact thing would be to say 0.00001 Bitcoin per dollar, which is just one over the opposite exchange rate. So we can use these ideas to come up with basic conversion formulas. So US dollars equals Bitcoin times the exchange rate USD to Bitcoin. Now that's kind of why it's useful. Remember up here we wrote it as a fraction, USD to Bitcoin. We can just write that as USD per Bitcoin. Now, if we want USD over here, notice that Bitcoin times USD over Bitcoin, what cancels? BTC. Because it's BTC over 1 times USD over BTC. And that's getting at the heart of what's called dimensional analysis because that would work across many conversions. But just making sure our equations are set up so the thing we want to sort of fall out of the equation cancels correctly. In this case, we want a US dollar amount, so we want Bitcoin to cancel out. So if we have 0.05 BTC, we could say, okay, 0.05 times 100,000. What is one? Remember, this is 0.05 BTC over 1 times 100,000 USD over BTC. Again, BTC cancels and we get 5,000 US dollars. So now going the other way, if we want to get BTC, it's the same thing, but now we're just using the opposite exchange rate, of course, because now we want BTC in the numerator and USD in the denominator. USD cancels, so we're left with Bitcoin on the left-hand side. So if we had 2,500, we'd have our exchange rate here, BTC over USD, 2,500 BTC times, sorry, 2,500 USD times BTC over USD leaves us with just BTC. So that's about 0.025 Bitcoin. Again, we're assuming this $100,000 price here, which isn't the current price. So now if we know, suppose we know a couple other exchange rates, because we could also have, here's US dollars per Bitcoin. Here's Ether or Ethereum per Bitcoin, which is the Ethereum is a different cryptocurrency, right? If we knew both of those, then we could end up with something like US dollars per Ethereum, but given just the exchange rates between the two. And now we can think about, okay, we want USD per Ethereum. So here, this is USD BTC divided by Ethereum PBTC. But what do we do when we divide fractions? We turn that to multiplication and flip this. So BTC cancels out right there. What are we left with? USD per BTC. And okay, actually, yeah, I wrote it. So BTC cancels out and we end up with USD for Ethereum. That skill right there, it's pretty simple as I walk you through it, right? That skill can be incredibly valuable if you're careful. At one of my first job interviews, I used to be an energy analyst, and one of my interview questions was like, if the price of oil is, I think it was more expensive at that point, so it was probably about $100 per barrel. And the question was, if the price of oil is $100 per barrel, how much does it cost to fill a 200-mile pipeline with oil? Okay, well, now we're dealing with a pipeline, which is like a circle and a cylinder. So we're thinking about the volume of a cylinder, which you thought you'd never have to think about until you heard this example. And so that's a much more complicated problem. But what I did was I sat there and I thought about what units do I need to get to? And then it kind of becomes a puzzle between filling things out. So this is a relatively simple example, but we could go crazy with this and be converting from across many different units. And so I wanted to show that too, because not only does it show up in the analysis of cryptocurrencies, but it also can be an incredibly useful skill. Energy markets, which I've dealt with a lot, there's tons of different units. Natural gas is priced in millions of British thermal units. Sometimes. Sometimes it's cubic feet. Electricity is kilowatt hours. So now we might have to think about, okay, energy content between natural gas or price of energy in natural gas versus price of energy in electricity. We're going to need to make a lot of unit conversions in order to make sense of those types of issues. So this dimensional analysis issue, well, it shows up, of course, in exchange rates and cryptocurrencies and many different types of finance. It also can show up in all different types of disciplines. So it's a great skill just to have in your head. Okay, getting rates, canceling what I need to go away so that I keep whatever output that I'm interested in. So a numerical example of that, we have 100,000. We'll assume that it's 40 ether per Bitcoin, which is approximately right, given our numerical examples here, because we're using 2,500 for ether and we're using 100,000 for Bitcoin. Those are not current prices. Those are a little bit higher than we have currently, but easy numbers to deal with. And then, of course, we can get back to our USD per Ethereum, essentially using this formula right here. Okay? So we only had USD per Bitcoin and Ether per Bitcoin, Ethereum per Bitcoin, but then we end up being able to get, okay, what does that make US dollars per Ethereum? So here I just have one thing I want to show you just about the code as I believe this may be our first time. I think it is actually going to a website, Coinbase, that has an API, which is basically something what oh we did this with Yahoo Finance, but I guess Yahoo Finance was a little bit different. Yahoo Finance is really nice from I believe our very first collab because that's a library. So once we import that library like we do up here, it's really easy to deal with. Other ones don't have libraries in Python necessarily, maybe Coinbase does, but here we're actually going to the API part of the website and then we use these tools from Python to just get data quickly off of the website. And so here right now we have the current price of Bitcoin when I ran this last, and this will update quickly. So this was not that long ago. 67,374.9 here. So that's in US dollars. And then here's our Bitcoin to Ether. So this is how many Ethereum currently are in a Bitcoin. So the equivalence across 30 at today's US dollar prices, 34 Ethereum equal one Bitcoin. And then, of course, we could get from these two what our price of Ethereum is here. And that's using that same formula we did up above, BTC to USD, BTC to Ether, and then we can back out. Okay, right when I ran this, it was $1,900 for one Ethereum coin. Um, the USD, this is the USD value, this first number, so we just have to read it down. 0.05 Bitcoin is $3,368. $1,000 is 0.015 approximately Bitcoin. And then this last example is us starting with USD per, or we're just using the two exchange rates, Bitcoin to USD, Bitcoin to Ether, to back out, okay, what does that imply dollars per Ether is? So this is one Ether coin is this many dollars, $1,946. So this just shows how we can apply immediately all of these different exchange rates to get in real-time information from an API and sort of play around with getting different values. So multi-step conversions, now we do a conversion that requires multiple exchange rates. So imagine, like we could imagine situations if we're dealing across borders, maybe we have exposure to different currencies. This type of thing could show up in trade a lot. Um, so maybe we want to go from USD to euros, but we're going to be using different blockchains. And maybe in this, and because we want to use blockchains, maybe we're trying to do it anonymously. Maybe we're going to be on the Bitcoin and the Ethereum blockchains, and then we're going USD to Bitcoin to Ether and then back to euros. That actually might be a relatively efficient way to do foreign exchange. Maybe not using both, but we could imagine I'm a US citizen, so I think of Bitcoin in US dollars, but I want to go to the Ethereum blockchain because I want to do a smart contract, which exists on the Ethereum contract blockchain, but not on the Bitcoin one. And maybe something about that smart contract pays in euros. So just thinking about the risk or the conversions that are underlying this transaction, maybe each of these steps are made. So if we do the conversion using three separate rates, we'd have Euro, USD. So here we have BTC over USD, USD cancels. Ether over BTC. So BTC is canceling now. And then Ether over BTC, Euro over Ether, Ether's canceling out. And so we have only euros after our cancellations if we're careful about it. We could imagine drawing these as the fractions that we have above, and then we could very simply see all the things that we want are canceling. What remains? Euros. So it's good to think about, okay, once we have this, now we have a lot of different types of risk that we need to think about because we need to think about the risk of those exchange rates probably being correlated, but possibly changing independently to some degree as well. So anytime we're converting across many different sort of currencies or assets, we also are introducing more risk to transactions. And so here's how we could see from that same API above, we can look at how we could make this conversion. So we're starting with 1,000 USD, going through the Bitcoin and Ether, we're ending up with about $845, and that is about right with today's US dollar euro exchange rate. So notice we have BTC and Ethereum here, but really what we're getting back is how many euros $1,000 is worth by jumping through those different exchange rates and getting the right cancellations. So now let's get a little bit deeper into smart contracts, what they are. You're going to read about them a little bit in your book. What I'm going to do is pretty specific examples. And really, I want to do this to get you thinking more deeply about finance and financial economics, which is a field of economics and is sort of a little bit different than just general finance, sort of looking more deeper at the theory of what's happening in these different financial institutions. And a smart contract essentially is a finance, it could be more broad than finance, but essentially is a new type of financial institution. It's a computer program that runs on a blockchain. And so that already is important given what you know about blockchains, because blockchains are like tamper evident. They cause things to happen automatically. They have a shared and very solid sort of understanding of history that people publicly understand in a decentralized way. So a computer program on one of those and automatically updates a public record because that's what's on a blockchain like Bitcoin. It is a public record. That's really where its value is derived from according to predefined rules. So this should be sort of like being like, oh yeah, this makes perfect sense that this would be aligned with what blockchains and cryptocurrencies are. Because what we do is we predefine rules to try to make incentive compatibility. So now smart tracks or contracts just allow for more complicated things to occur on blockchains. So instead of saying, trust me, I'll decide what happens, like, trust me, I'll pay you back later, it might be sort of like, okay, the second that Gavin's lawnmower is done with my lawn, a smart truck contract executes, and then the money automatically goes to a bank account, as opposed to trust. I'll just pay you when you're done mowing the lawn. That's kind of a weird example for a bunch of reasons, like me mowing the lawn isn't on a blockchain. But that's going to be an important thing about smart contracts because sometimes everything, all of the data a smart contract can need could be data that's on the blockchain. But sometimes smart contracts actually have to go to different sources of data that isn't necessarily data related to a blockchain. That in some sense might be considered a weakness, considering what the goals of things like the Bitcoin blockchain are, is it wants to be self-contained. It doesn't want to have to go depend on information from other places because maybe that information is centralized. Maybe it's coming from a centralized exchange or a bank. But those are exactly the types of institutions that blockchains tend to want to try to escape from. So that's important to think about from the sort of the political economy of blockchains. So what a smart contract does, instead of having trust me, will decide, will have human discretion. Smart contracts say no, if condition X happens, then outcome Y happens automatically. There's no human discretion. It's written on the blockchain. It will happen automatically through verification and using sort of some of the cryptographic rules and the blockchain type rules we've already discussed, but it will remove entirely any type of human discretion from the operation of a contract. Because a smart contract does not think, it does not interpret context, it does not judge fairness, and does not pause unless explicitly coded to do so. Pausing we'll come back to because that's maybe one of the things that happen in other types of financial institutions that smart contracts wouldn't allow to happen in many cases. So in a traditional financial system, exchanges might pause trading. This is something that happens. Circuit breakers are an example of this. So the New York Stock Exchange will stop trading if price moves are big enough, for example. Governments might close markets. Platforms like exchanges might freeze accounts. Banks can reverse transactions. Regulators can intervene during stress events. Courts might delay enforcement, so maybe there's some fairness things going on that courts might get in the way of. None of those are necessarily bad things. That's important. But they do allow for human discretion. Human discretion can be good and it can be bad. Smart contracts are not going to allow any of those things to occur in general because it's literally computer code that causes things to happen now. There is no human discretion. So in a smart contract system, if the code says liquidate when the collateral falls below 2150%, it will liquidate no matter what. There will be no human discretion around that. If the code says allow swaps at any time, swaps will occur at any time. If the code says release the funds when are met, funds will be released. Now we can imagine different situations. You might have countries that fail to pay their bond obligations. So this happened in Argentina, for example. Now, courts then have discretion to say, well, just pay them back this much or that much. If all of that was in smart contracts, it would be a very different situation because there would be no judgment from a court. Whatever the smart contract says should occur in event of a default would occur in event of a default. Versus in real defaults that we've observed, usually there's many, many years of court proceedings and back and forth about what the best way to deal with things are. Again, neither of those is necessarily worse or better, but they are definitely different situations. So many smart contracts. So we started with exchange rates, A, because those are important to know about. Dimensional analysis is important to know about. But many smart contracts would imply the existence of underlying exchange rates or would depend on underlying exchange rates. So many smart contracts involve multiple tokens. Many of them have Ethereum because the Ethereum blockchain is definitely the most popular blockchain for things like smart contracts. And that's the reason that's probably the second biggest blockchain after Bitcoin. And really growing because a lot of different businesses are looking into the Ethereum blockchain. How can we use this smart contract functionality? So stable coins, of course, are a big thing nowadays. Tether, we've already talked about. USD, so the US dollar coin is another really big stable coin. So those ones are meant to just trade one for the dollar. That's their goal. Wrapped tokens are things like we could imagine, so Bitcoin do not exist on the Ethereum blockchain, but things that exactly track the value of Bitcoin do exist on the Ethereum blockchain because that can make the Ethereum blockchain more efficient to the extent that a lot of people are trading Bitcoin value on that blockchain through things like smart contracts. So a wrapped token is a token that represents value, usually of a different cryptocurrency from a different blockchain, but on this blockchain. So if we're looking at the Ethereum blockchain, we might be looking at a wrapped Bitcoin token. Its value is the same as Bitcoin. Its code is written to exactly track the value of Bitcoin, but it is not actually a Bitcoin. So liquidity provider tokens, we're going to use an example directly from this. You can earn fees, so earn some interest, maybe is one way to think about it, although it is not exactly interest, it's more like a fee, by providing liquidity to blockchain. So people might be trying to engage in different trades, maybe between Bitcoin and Ethereum on a blockchain. Blockchains, because they're not centralized exchanges, need individuals to be willing to provide liquidity to try to make those transactions more efficient. I shouldn't say they need that, but by having that, they will be much more efficient if they have individuals willing to say, hey, I'll just put a lot of Ethereum and a lot of my Bitcoin into this bucket. And then when people want to trade Ethereum for Bitcoin, instead of waiting for somebody else who wants to make a similar trade, they can just go to this bucket. If they want to buy Ethereum from it, that's okay. If they want to, so they can sell Ethereum in it and take out Bitcoin, or vice versa. These liquidity providers, by putting a lot of Ethereum and Bitcoin in the bucket, will make that happen very quickly because they'll just say, yes, I'll sell what they want to buy, I'll buy what they want to sell. So those trades occur quickly. That blockchain gets a reputation for being efficient and liquid, and more people want to exchange on it. And then that helps with liquidity too. More people trading in a market leads to more efficient markets generally. It's easier to find people that are willing to be on the other sides of our trades. Governance tokens are another type of token. So some blockchains might allow users to vote on changes to the rules of the blockchain. You'll be reading a lot about that in your reading this week, so-called forks. Now, those tokens might exist in smart contracts. So, for example, it might be like in order to be a voter on the Ethereum blockchain, you need so much value involved in the Ethereum blockchain. So, if this user owns X amount of Ethereum, they get a governance token. That could be a smart contract. And by writing into a smart contract, that ensures other people, other stakeholders in the blockchain can see that that's a very transparent thing. How does governance work on this blockchain? Well, you have to have enough skin in the game, namely have enough Ethereum in order to get a governance token. And then those people who have those governance tokens are voting. That might be good from a governance standpoint, because if somebody owns a lot of Ethereum, they're going to want to make the rules such that Ethereum is as good as a blockchain as possible because they want more people using. They don't want to destroy the value of the thing that they own. So there's some incentive compatibility there. But I was being specific and sort of fast and loose with that discussion, but that's what governance token sort of means. And often those are in smart contracts. So each of these tokens will have its own exchange rate. So to understand payoffs, we must track all of these different prices, and to understand outcomes, we must track multiple prices at the same time, oftentimes. And the more complicated the smart contract is, the more things we probably need to track. So really the first one is probably an overly simplifying example, but we could have a smart contract that said something like their agreed price is $1,000. The contract reads a reference exchange rate US dollars per Ethereum. If enough Ethereum is sent, transfer the asset. And I just said the asset. Maybe the asset is um, one of those, this is dumb that I'm not thinking of the name right now, but one of those pictures of the monkeys that I just saw an article about. Justin Bieber bought a monkey picture for 1.3 million and now it's worth $12,000. So that was a bad investment. Why am I not thinking of what those are called right now? I'm having a brain fart. I'm sure you guys know what they're called. They're the pictures. digital. Ah, I just completely lost the word for it, but some asset. And so we could imagine a smart contract says if $1,000 of value is sent, but in Ethereum, because maybe this is on the Ethereum blockchain, then release the asset or transfer the asset. So in rule form, if Ethereum sent is greater than 1,000 over this exchange rate, because that's how we're going to convert that to the US dollars, which are referenced in the smart contract, then release the asset. Now we could suppose that Ethereum is $2,500, and then we could have zero point 0.4 Ethereum. As long as zero point 0.4 Ethereum is or more is received, the smart contract would release the contract. But notice now if the price of Ethereum falls in US dollars or the exchange rate changes, that will have implications for the contract. In this case, more Ethereum would have needed to be sent because the asset won't be released at this exchange rate because we only end up with 800 US dollars. So notice that the uncertainty in that oversimplified example lives in the Ethereum USD exchange rate. So now a more complicated but important example. So I actually had somebody reach out to me to talk to him about a real life example that's very similar to this one. So that in part motivated my using this example. So this is similar things to this occur on blockchains. So now we're going to do a liquidity provider smart contract. So users deposit Ethereum and US dollar coins. So that's that stable coin. It's a cryptocurrency, but it's managed and to track $1, 1 USD per $1 as closely as possible. And they put that into what's called a liquidity pool. You can just think of that of a bucket. On day one, the easiest thing to imagine is that bucket has $500 worth of US dollars in it and $500 worth of Ethereum in it. So it's about 50-50 worth of value on day one. And then what though the reason the people are willing to put their money in that bucket and provide liquidity because there's people who want to trade Ethereum against the US dollar out in the broader market. Now, by these liquidity providers, their willingness to provide this pool of money causes the other market to be able to really efficiently do these transactions because there's this big pool of both currencies sitting there. Other market participants can say, "Hey, I want to buy some Ethereum with USD right now." The liquidity providers, some of that money in that pool will immediately do that exchange at whatever the current exchange rate is in the pool, which we'll see what that's going to be in a second. That means that those transactions occur quickly. Traders like that, they're more likely to be willing to engage in transaction in worlds like that. Because when are people not wanting to exchange in markets? When they go to the market and say, "Hey, I want to do trades in this market," but nobody is there to trade with them. They just can't find anybody to either buy from or sell to. That leads to price action in markets. A lack of liquidity can change behavior big time. People don't want to engage in those markets. So, providing liquidity is a very valuable service. And for that service, these liquidity providers can earn fees. So, but we want to do all this in a decentralized way, so we need to do it with a smart contract. So the smart contract maintains the rule that the product of reserves remains constant because we put all of the money in the pool. If prices move significantly one direction or the other, then either there needs to be more Ethereum in the pool. Naturally, if people go want to buy Ethereum, that means they're putting US dollar coins in the pool, taking Ethereum out. What's happening to the pool? It's shifting in the direction of having more US dollars in it. What if people are trying to sell Ethereum for US dollars? Then more Ethereum coins are going in the pool. US dollars are leaving in the pool. So the proportion of Ethereum in the pool is increasing as those trades occur. So we're going to try to manage the smart contract will. We're not going to try. The contract will manage the pool such that reserves in the pool remain constant. So X times Y has to always equal some constant K. So if Ethereum in the pool is X and USDC in the pool is Y, then we're going to make it so those two multiplied by each other always equal some constant. So, and then the contract will also have rules in it that distribute proportionally, meaning if you put more money into this pool, you're going to get higher fees. Now, there's definitely risks associated with being in this pool. So in rule form, it's if a user deposits tokens, then update reserves so that x plus y, x times y equals k, and issue liquidity provider tokens representing an ownership share. So if I put money into this pool to be a liquidity provider, I will receive a token, which basically acts as a receipt that says Gavin put this much money in the pool. Therefore, when fees from the pool are distributed, he earned this proportion, which will be based on whether the information needed to give me my proportional share will exist in the liquidity provider token that acts as my receipt for putting money in. And now, again, all of these things are cryptographically defined in ways that you will understand now. Like, how do we know Gavin owns this coin? Why? Because it's connected to his public address on the blockchain and things like that. So all of this is happening cryptographically. There's no human judgment occurring here. So everything's just looking at the smart contract. The smart contract has those cryptographic rules in it, so it itself can check all of the conditions. What share does Gavin get based on his address, based on his wallet address, and things like that. And so all of that is happening cryptographically now, as opposed to there's liquidity providers at places like the Chicago Mercantile Exchange. The exchange itself will provide a lot of liquidity. That will all be happening with definitely contracts, but also with centralized exchanges and more human discretion will be happening in those situations. So again, these are all smart contracts exist to try to replace that other digital currency system. It really all ties back to that. Now we're just getting into replacing some more complicated stuff that the traditional financial system does. So we'll suppose just a numerical example. The pool starts with 10 Ethereum and 25,000 US dollar coins. So that means K, the constant at that point, is 10 times 25,000 or 250,000. So then we can say, well, what's the implied price within the pool? At that point, the implied pool price is $25,000 over 10 or 2,500 Ethereum, which again, we're just going with that example from above with the assumption that Ethereum is 25,000. We know from above as well that it's actually a little bit less than that today. So now suppose Ethereum rises in the broad. We're going to do, I guess we're just going to do one case here, just talk about what happens. But then in other, going to have you, I think I give you option to think about this, but this would be a good thing to think about if you want to try a different example for the homework. Or even if you don't do that for the homework, definitely worth thinking about the opposite. What if Ethereum falls? I don't think I do that down here. No, I don't. So. Now, what's going to happen? So now the pool price is going to be off canter. So the pool price isn't going to make sense anymore once the Ethereum changes because we need to get back to this 25,000. So arbitrage traders will buy Ethereum from the pool because why will they buy it from the pool? Because remember, the pool price up here was $2,500, but now this is saying out in the broader market, Ethereum is $3,000. So in order to make some easy money, traders should buy $2,500 Ethereum from the pool and then sell it for $3,000 in the broader market. Well, when they buy Ethereum from the pool, what is going to happen to the amount of Ethereum in the pool? Like maybe it goes to nine. And then this 25,000 divided by nine is going to become a bigger number. Now, once the 10 decrease the denominator of this decreases enough, eventually we'll have 25,000. And by the way, they're going to be buying Ethereum from the pool. So they put US dollar coins in, that causes this number to increase. They take Ethereum out, that causes this number to decrease. Both of those lead this number to become bigger and go towards the market price of Ethereum of $3,000. So just by the self-interested actions of people who want to make money, the pool price will, and this ratio will change in a way that goes to the market price because they will want to stop doing this. And they'll be doing this instantly, basically. They'll want to stop doing that once this price equals this price because it will no longer be profitable to do that. So we don't need a centralized exchange, just the self-interest of those arbitrageurs will lead the 2,500 to the 3,000. So that's how the liquidity provider pool can help increase the liquidity in markets and make it so that it's really quick and easy to make trades and get price stability across different places where we might see Ethereum prices. So to reflect the new internal price of 3,000, what had to happen? They had to go to 9.13 Ethereum. And then notice that now there's also more USD in the pool. So this is where those numbers should settle because remember we said this one's going to get bigger as US dollars go into the pool. This one's going to get smaller and then we can just do this math to get to the okay, well what are the new numbers after that? Now let's think about what's going to happen in the long run now. Notice that if this kept happening, if Ethereum kept rising in the outside market, then the pool would end up eventually with only dollars in it. And then basically what would happen is if Ethereum would eventually leave the range that's even feasible by this condition, this would get ridiculously small. This would get ridiculously large. So for all intents and purposes, the pool would be only full of US dollar coins. It would no longer be worthwhile. It would be no longer adding valuable liquidity to the market because it doesn't have both assets really in it anymore. And now what liquidity providers would do is like, okay, just I'll withdraw my liquidity now as US dollar coins, by the way, because that's all that's left in the pool. And now I'll just be sitting. Hopefully, I made a lot of fees in that action. Now, to some extent, whether that's a good outcome or not sort of depends on the goals. It might be a little bit more stable of an outcome if Ethereum rose. Now, we should also think about the other case. If Ethereum crashes, then the pool is only going to have Ethereum in it. And so the liquidity providers are going to get Ethereum out of the pool. But notice in that case, now they have the by far less valuable asset. It could have continued to crash even below after the pool turned completely into Ethereum. And now that could be a pretty big risk that these liquidity providers are taking. So it's worth sort of thinking about, and this happens in other markets too, liquidity providers. What's quite different about crypto markets is basically any person, any human can do this in a cryptocurrency market. There's pretty hardcore regulations for doing this in traditional financial markets. Why can pretty much any human do this in cryptocurrency markets? Well, they're anonymous. So you couldn't even regulate. You could regulate minimum size. Maybe you can't just put a penny worth of value in the pool. So you could regulate on that basis. And many traditional financial institutions regulate liquidity providers on that basis too. You have to prove that you have a lot of assets. We could do that with a smart contract. So that type of regulation could exist. But other types of regulation, you have to show that you've passed the CFA exam to be a liquidity provider on an electricity congestion exchange or something. Those types of regulations would be more difficult to do on an anonymous blockchain. So what happened? The pool moved from 10 Ether and 25,000 US dollars to 9.13 Ether and 27,390 US dollars. If Ethereum had risen more, roses to $5,000, then this is going to get even bigger, rises to $20,000, even bigger. So the pool moves in the direction of the asset that is not going up as fast, or It's the asset that's going down in that case. In this case, we have Ether increasing in value. So that leads US dollars to be the relatively less valuable asset, and the pool begins to get more full of the relatively less valuable asset. So thinking of supply and demand, what's happening there? Why is Ethereum rising? Because the demand for it is increasing. So people go into the pool, buy it. That's the reflection of their demand. I'm going to buy the thing I demand out of the pool. I'm going to supply US dollars to the pool, and the relative prices reflect that exact action. So we can definitely think about this in supply and demand terms as well. So what is the smart craft contract doing here? Always update balances so that the constant product rule holds. X times Y equals K, which was our $25,000 in this case, or 25,000 not united things in this case. So think about that statement if you need to. Where the uncertainty lies, the Ethereum US dollar exchange rate can move. So this is what leads to uncertainty for these liquidity providers. Trading volume determines how quickly reserves change. So if a lot of people are trading, this could happen instantly. But if it's only a few people, it could take a really long time. The pool composition adjusts automatically based on the rules set in the smart contract. And then liquidity depth affects how large price moves are during rebalancing. So if this is a huge pool with billions and billions of Ethereum and US dollars in it, then it's going to be really stable. It's a very deep liquidity. Lots of people are trading in and out of the pool. That will lead to smaller price moves during rebalancing, more continuous and more stable price moves. If it's very illiquid, so there's hardly any trades, then all of a sudden we're going to see large price moves when a transaction occurs. So a next example, and I wanted to use this example because Michael Berry, who's famous for shorting from the movie and the book The Big Short, is an investor who's famous for shorting the housing market in 2007, 2008, and he made a lot of money doing that because you may recall, or maybe you're too young to recall, that the housing market in the United States crashed big time in 2007, 2008, 2009, maybe it kept going. But an investor who's now, he writes blogs, and a lot of people think about what he says. He recently wrote a blog saying there's a danger in connections between cryptocurrency markets, namely Bitcoin, and metals markets, namely gold and silver right now. So this example is an attempt, A, to teach you more about smart contracts and about finance and things about margin. Margin means I'm going to bet on speculative assets with borrowed money, which will allow me to increase my return. Maybe I only have $100 in my bank account. If I invest $100 in silver and it goes up 25%, I made $25. But maybe instead of doing that, I can find somebody to give me $100 loan in addition to my $100. So now I have $200. I really only have $100, but I have $200 to bet. So now I'm going to buy $200. I'm going to end up with $50 of return, $25 per each $100 bet on silver. And now I earned $50 even though I only started with 100 minus some interest that I'm going to have to pay whoever sold me the money. But my return is much higher as a result of my ability to borrow money. That essentially is speculating on margin. People do this with stocks and futures and in speculative financial markets all the time. Now, the flip side of that coin is if that silver futures decline in value, I will lose much more money. And I might lose so much money because now I've made a $200 silver bet, but I only have $100 of equity in my bank account. If silver prices go down by more than half, I lost all of my money. Not only that, I will not be able to completely repay back whoever loaned me the money. And so there's a lot of complicated financial stuff that goes around what I just explained. I'm going to explain one in a smart contract that very much aligns with this Michael Berry person's current concerns about connections between Bitcoin markets and metals markets. So let's just go through the details. So we're going to have Bitcoin collateral. So the collateral in my example was like, look, I have $100 in my bank account. So we could write the contract. Whoever I borrow the additional $100 from says, I get that $100. That's the collateral for this loan. So in this coin, we're going to do that, but with Bitcoin. So we could use Bitcoin to say, hey, look, I have this collateral. I might have, and another way maybe to tie it to something you're more used to. If you own a house or you know somebody who owns a house, your house is the collateral for your mortgage. So if you stop paying your mortgage, the bank is going to come take your house, sell it, and take that money. So in this case, we're going to put Bitcoin in a special account. It's going to sit there, and then we're going to borrow money from people to make bets on silver prices, silver futures specifically. Where are we going to do it? We're going to do it on the Ethereum blockchain. Why on that blockchain and not the Bitcoin one? Because the Ethereum blockchain is the one that allows smart contracts. So this is how things can start to get complicated with contracts. So maybe we have wrapped tokens that represent Bitcoin value. I prove that I own those wrapped tokens with my address. I put those to the side and say, here's my collateral. And then creditors that are also willing to put money on the blockchain to earn fees say, okay, we'll have a smart contract where you borrow this money. You're allowed to bet on silver futures with this money. If silver futures decline, we're going to come in and take your Bitcoin, liquidate it to try to pay ourselves back. So that's broadly speaking what's going to be happening here. So in this case, liquidity providers deposit US dollar coins into a pool that funds silver futures positions. Why US dollar coins? Because US dollar coins, I mean, silver futures are priced in US dollars. So that's why the liquidity providers, or really we should probably think of these as creditors rather than liquidity providers in this case. But creditors are going to be putting US dollar equivalents, US dollar coins into a pool. Other people can access that money and then bet it on silver futures. Why are the creditors willing to do this or the liquidity providers? Because they can earn fees by doing this. Users, like we'll pretend I'm going to be the user. So I'm going to deposit Bitcoin, or really because I'm doing it on Ethereum, it's probably wrapped Bitcoin tokens or some proof that I own Bitcoin, some tie to my ownership of Bitcoin as collateral. This basically says, hey, look, I'm putting some collateral aside so that you allowing me to borrow this money and bet it on silver futures can feel a little bit safer about that, at least. Because if things go haywire, at least you can go take this correct collateral, liquidate or sell it, and then bail out of the situation. And they don't have to sell it, maybe. Maybe they can just accept the Bitcoin. That kind of depends on the creditor's preferences or the liquidity provider's preferences. So the contract allows the user to open a long silver futures position priced in US dollars. That's where silver futures are priced in US dollars. Other foreign currencies as well, but for our purposes and for most markets, silver futures are priced in US dollars. So what the contract will do is it's going to continuously calculate the user's equity. So again, I'm the user. I put in Bitcoin collateral. So that's part of my equity. That's just sitting there in account. And then I'm going to borrow this. I'm going to take these US dollar coins, buy silver futures, or maybe wrapped tokens that represent the value of silver futures, which we could do too. And that's going to be if silver futures, so then I do that. Maybe silver futures go up. Now I have my Bitcoin collateral, plus I have an unrealized profit from the fact that the thing I bet on, silver futures, increased in value. So this is sort of the good case for everybody. The user, Gavin's making money. The creditors are happy because Gavin's clearly going to be able to pay them back if silver futures increase. But then, of course, there's the other case where the silver futures decrease. Then I have unrealized losses. Now Gavin's not happy because he's losing money, and the creditors should be worried because maybe I can't pay them back if my loss gets big enough, if it starts to eat into my collateral value. So the contract is enforces 150% maintenance margin relative to the position size. So in rule form, if equity, this number, what I put in Bitcoin plus my unrealized profit or loss, is greater than whatever I bet my initial bet on silver futures needs to be greater than 1.5. So if I put $100, so on day one, before silver moves at all, I put $100 worth of Bitcoin value in. That's my equity, so that will be 100. And then if I bought, let's see, if I bought 1.5, is that right? No, 3 over 2. So I can buy like point, I can buy basically 2/3 of that value in silver and then one divided by 2/3. So about 0.66 or $66 worth of silver, then that would be about exactly 1.5. That would be the maximum amount of silver that I'd be allowed to buy with my initial 100 Bitcoin collateral. Now, after this, the notional, so that notional value won't change, but the equity value will change. Neither the BTC, well, we'll see. The BTC collateral value can change, and that's what makes these a little bit more risky and what this Michael Berry person became quite worried about. Then maintain the position if the equity over the silver, so where? Or sorry, so if this is true, maintain the position. However, if this becomes true, immediately liquidate the position and return the BTC collateral to the USDC pool. So now suppose liquidity providers have supplied USD. So that's the creditor saying, here's some money that other people can borrow and make speculative bets with. It may or may not be that it's specific to a very specific, like silver futures bet. It could be more general than that. But creditors or liquidity providers provide US dollar coins to the pool. A user deposits one Bitcoin. We'll assume, so now we're going to use for this example a $40,000 Bitcoin price. The user opens a $25,000 long silvers position. So the initial equity, again, this is only the profit or loss. So there's been zero profit or loss at this point, the instant we open the position. So we have $40,000 worth of Bitcoin and we have zero profit or loss so far. So our equity is 40,000. Our notional silver position is 25,000. So we're good now because this is 1.6. That's greater than or equal to 1.5. So this is okay. We're going to maintain the position. So let's do a couple cases of what might happen now. Well, if Bitcoin falls to 30,000 and nothing, well, so silver doesn't change at all for this part of the example, then 30,000 over 25,000 is 1.2. We've fallen below the 1.5 threshold. So the smart contract will automatically sell the silver's position. It'll close that out, even though nothing's changed about that part, because we've fallen below this maintenance. It transfers the Bitcoin collateral to the USDC pool, and then it uses that Bitcoin valued at a current price to cover the $25,000 exposure funded by the liquidity providers. So it pays them back. And then the leftover Bitcoin will go back to the user because they were able to. It's like, okay, the bank took my house, they sold my house, but then I owed $200,000 and they sold my house for 300,000. They'll take the 200,000 and they'll give me 100,000. They'll give me the extra proceeds, presumably with massive fees, of course, in that case. So I probably wouldn't get all of the 100,000, but both of us would get some of it back in that case. Now suppose BTC remains at 40, but silver falls and the position loses $8,000. So the new equity, 40,000 minus 8,032. Now we're back again. And this one is because Bitcoin didn't change, silver changed. That led us to fall below the position. So again, we're below 1.5. So the smart contract closes because we're above 1.1 still. The creditors get paid back and the user loses money but gets some of their money back. So finally, silver rises. That's going to bring us farther away and make us even safer because now equity has gotten larger. The notional position value doesn't change because that's the borrowed money that went into the position. So really, this is the safe area, and this is probably what a lot of people were enjoying in January of this year. But now, since then, both silver prices and Bitcoin prices have fallen a bit. Notice what happens is Bitcoin generally will probably be sold as a result of this. So that will decrease. This action could cause a cascading Bitcoin price to the downside because collateral is in Bitcoin. These positions are being liquidated. Bitcoin is being sold for US dollars more likely. The supply of Bitcoin is increasing. More people want to sell Bitcoin like these liquidity providers. That causes Bitcoin to go down more. At the same time, in order to liquidate these positions, silver is being sold. And sort of a lot of these Michael Berry's question, and he believes this might be true, is there's a lot of contracts sitting out there like this right now. To the extent that those represent a lot of value, you get double risk in Bitcoin falling or silver falling, because we saw in cases one and two, both of those led to problems with the contract, led the silver position to be liquidated, which would cause silver to go down more if there's a lot of those positions. Meanwhile, if Bitcoin prices go down, that causes these to be liquidated. That then can cause people to liquidate silver positions. So you can get basically compounded risk of falling prices as a result of these things, Bitcoin and silver or other metals being tied together. So, stepping back a bit, this is how a smart contract could work, but a lot of this is similar to how maintenance requirements are maintained in other exchanges. And so there's a lot of depth to this financial example that is true in not smart contract versions of how. So, in many exchanges, people will bet on futures with borrowed money. The futures prices will fall. The creditor will say, you need to sell some of this so you can pay me back. Well, if that happens to a lot of people at the same time, prices fall further. Creditors come back and say, hey, you need to sell even more because prices fell further. And then that can lead to a snowballing effect of falling prices. So what did the smart contract do? It enforces 150% margin ratio based on total equity. So where does the uncertainty lie? Well, it lies in the Bitcoin USD exchange rate, and that's volatile. Silver USD price volatility, because both of those can change it. Correlation between Bitcoin and silver, and there could be correlation between Bitcoin and silver not related to this contract, but if we just discussed, if there's a lot of contracts like this, that will lead to more correlation between Bitcoin and silver. Speed of price changes matter. Oracle timing and accuracy. It may an oracle, because I said earlier in this lecture, maybe we have to go off of the blockchain to receive information. If if we're ever going off of the blockchain to receive information, for example, maybe a smart contract relies on information provided by the Chicago Mercantile Exchange. The Chicago Mercantile Exchange is a centralized exchange. When blockchains receive information like that, often in the form of smart contracts, because smart contracts maybe depend on information like that, we refer to that information as Oracle. When does it receive that information? Is it accurate information? So when blockchains receive information from sources that are not on the blockchain, that is called oracle information, or really whoever, whatever entity is providing that information is called an oracle because it is not coming from the inside of the blockchain, it's coming from the outside. Liquidity conditions of can matter a lot too. Like if there's not a lot of liquidity, if people are trying to sell out of some of these positions, if they're not liquid positions, that could become a risk issue as well. So just a summary, a general summary of smart contracts. Smart contracts automate rules. They ensure that there's consistent execution, transparent logic, and predictable behavior given inputs. But economic outcomes depend on things like exchange rates, liquidity conditions, timing, incentives, and market structure, of course, as they always do. Rules determine mechanics, markets determine value, and there is no human discretion in smart contracts, except maybe when we start thinking about this Oracle issue, opens the door maybe for human discretion in some contexts. So then I did a little simulation here for the LP. So this is the example two. We can think about different things that might happen. So I'll have you guys read through this. We had to make some assumptions here, but the question is, okay, we in that example again, we put US dollar coins and Ethereum coins in a pool. That's what the liquidity provider is to do. I wanted to show you guys through a simulation about what happens to this pool with major price movements and what happens to the proportion of Ethereum and US dollar coins in the pool as those happen. So we can make some graphs here. So in this first example, we just have not major moves to one side. The Ether price or exchange rate stays relatively, that's the blue line. It's volatile, but it's not going up or down in the long run. And we can see, okay, when the Ethereum price is going up, so let's look at this spike right here. As it's going up, the amount of Ethereum in the pool is falling. Why? Because traders are going into the pool, buying Ethereum. That's actually exactly consistent with the price rising, right? Demand is higher. What does that show up as? People buying. So people are buying, that's the price going up resulting from those buys. But then in the pool is selling the thing that people want to buy. So the proportion of Ethereum in the pool is falling. Then the Ethereum price starts to fall. That's people selling Ethereum. So there, Ethereum is rising. The proportion in the pool is rising. But notice we start at 50%. And in this version, we stay stable, bouncing around 50% with those moves. But on average, we're staying right in the middle. And then we can see some basic statistics about where we started, where we ended. Now, case two, we're going to have the Ethereum price rise dramatically. So what should happen is traders go into the pool and they're buying Ethereum to be consistent with this arbitrage. So maybe some big single in the market says, oh, Ethereum's going to go to $1 trillion, so everybody wants to buy it. Traders specifically want to go buy Ethereum from the pool to get this arbitrage action that we discussed in the example above. So Ethereum's going to leave the pool over time, and so here we start at 50%. The Ethereum price rises. People buy Ethereum out of the pool, replace it with USDC because that's the trade they're doing within the pool. And we see that the amount of Ethereum in the pool converges to zero. Now, Grisham's law, good money drives out, or bad money drives out good money. That's kind of an interesting case to think about the pool. In this case, people want Ethereum. What ends up in the pool is the US dollar coin. So, relatively speaking, not what Gresham was talking about in his law, but in relatively speaking, the bad money drove the good money out of the pool. The people want to say, I want the good money, the Ethereum. That's the things whose price is rising relative to the US dollar. So the pool is left with just US dollars, no Ethereum. How do we know that? Because the percentage of Ethereum has basically gone to zero as the Ethereum price has risen. We can also take a look at the opposite case, of course. Here we have Ethereum price crashing. Now the pool is 100% Ethereum. Now, this is probably the biggest risk case for the liquidity providers. They said, I want to earn fees by putting Ethereum and US dollar coins in the pool. Now, and then so they're sitting there earning fees. Meanwhile, the Ethereum price crashes. At the end of the day, the liquidity provider ends up with only Ethereum, but the Ethereum price has crashed. So this is really the big risk probably from the perspective of the liquidity provider. Probably they're thinking about life mainly in US dollars. And so this is a bad case for them. They end up with all Ethereum, and Ethereum has a low price at the end of the day. So now big shift. So that was all smart contract stuff. Pretty deep finance happening there. I'm happy to meet with any of you, talk about that. Send me emails if you're confused about any of those issues. A lot of what we just described correlates with many big issues in traditional finance and how exchanges and liquidity works in exchanges. So a lot of that is not specific to blockchains or cryptocurrencies. What is specific to blockchains and cryptocurrencies is the smart contract part, as opposed to having courts and contracts written by humans that judges may say, no, this contract is weird. We don't actually have to live with this, or maybe renegotiations. No, none of that's going to be happening in smart contracts unless they explicitly allow for it as written into the smart contract. So that part is different from from other traditional finances, but a lot of the discussion of how liquidity works and how margin rules work, that correlates pretty well with a lot of how traditional finance works. So your book also talks about some on-chain data things. So I just wanted to show you because the book is getting a few years old. Um, and I apologize for that, but I think it's kind of interesting to see because he makes some predictions. Some of them turn out to be pretty good. Some of them turn out to be horrible. So let's take a look at. So one thing he talks about is transaction fees and market concentration. So we're going to compute the average transaction fee on Bitcoin during 2025. And we're going to do, actually, I decided to deviate from that. So we're going to just look at transaction fees in recent Bitcoin blocks. And then a pie chart showing mining pool concentration. That's something that the in the book they explicitly show a pie chart of that exact thing. So average transaction fees reflect a demand for block space, which I've discussed a little bit in the last lecture, and you'll be reading about in this reading. But transaction fees are like, hey, I want my transaction to occur. I could just put zero transaction fee. If there's not congestion on the blockchain, that might be fine. But we can imagine a world where there's tons of transactions in the mempool who want to be on the next block, but maybe there's so many that there's actually congestion. And that congestion could lead to, hey, I have to wait for my transactions to be validated. Well, including a transaction fee increases the probability that a miner puts their transaction on a block. Why? Because the miner will get that Bitcoin or whatever blockchain we might happen to be on, because there's transaction fees on other blockchains too. Mining pool concentration could be an issue because we could be worried about increasing centralization if miners are concentrated. In fact, if one group of miners owns 51% or more, or really more than 50% of the computational power on the blockchain, that could become an issue. And in fact, later in the class, we'll look at some math that says it might not have to be quite that high. So these metrics connect directly to incentives, higher fees, stronger incentive to mine, greater concentration, potential concerns about one of the major motivating factors for blockchains is chains at all, decentralization. So we can do a similar thing. We can go to this blockchain info. This is like connecting to an API, kind of like above. It's a little bit more complicated. So you don't have to be super worried about this code, but I might have you look at things like different block heights. But basically, we can see right here. So 936, 914, 936, and 928. So these are pretty recent block heights on the blockchain. And what are we looking at? We're looking at the cumulative transaction fees. So these are not transaction fees for one transaction, because as we've seen, there's many transactions on a block. Here's all the transactions on this block. This transaction up here, we can see, okay, 3.129 is the block reward. That's the total block reward. That is more than the built-in block reward that is still exists as a result of making new Bitcoin when we mine blocks, which we looked at last time. This is more than that. The additional is the cumulative transaction fees on all of the different transactions on the block. So that's why these vary. So on these blocks over here, we didn't get that many transaction fees in cumulative, but then on these ones, we got pretty big cumulative transaction fees, so 0.016 Bitcoin. And then here we're making a mining pool share. This is exactly like your book. The big blue one is unknown, and that's kind of interesting because it's like that could be millions of different people, or that could be a bunch of people colluding with each other. So there's actually some uncertainty there. But then these ones, so Ant Pool is the biggest group of miners that we know that this slice, so this proportion is ant pool, that slice is about 17% right here. Unknown share is about 60%. That's what that blue is. And then we could add up the top four reaches about 40%. So now you can think about, well, what if those top four pools, so that's Ant Pool, Via BTC, F2 Pool, and Brains Pool, if those four colluded with each other, that would represent almost 40% of the computational power on the blockchain. And so, I mean, if that reached 50%, that would definitely be concerning from a centralization standpoint, simply just a pure market power standpoint too. And so this is the mining concentration is something that Bitcoin sort of watchers pay attention to. They also pay attention to this unknown because is there a pool that's even bigger than Ant Pool living in the unknown? Maybe, and maybe they're just doing a good job of hiding that they are mining together. So that's why those issues are important. I'll have you answer some questions and get into deeper or discuss more deeply why those could be issues in terms of the economic institutions that we've discussed. So please take a look. Don't hesitate if you have any questions about this stuff. Schedule is the same. I think my next, I don't remember if it's next week or the week after, but I will give you a break at least on the collab as we're preparing for the midterm exam. And I'll definitely talk both in the weekly overview and in the video about what to expect from that exam. But it will be multiple choice questions. Some will be similar to the quiz stuff, so it's important to really make sure you understand the issues there, but also some questions that relate to things you've answered in the collab assignments and other things we've covered in the book and readings so far. Okay, I'll see you guys next time. Have a good week.